What happens to your business when you're gone? I've seen families lose businesses they built over a lifetime in a matter of months. Not because the economy turned, not because they made bad decisions, because no one ever signed the right document. I'm Greg DuPont. I'm an estate planning attorney and a certified financial planner here in Dublin, Ohio. This video is part of my mission to positively impact 1 million lives, and that includes helping business owners right here in Central Ohio finding the truth of their situation before there's a crisis. Stay with me, because by the end of this video, you'll understand the 4 ways a business transfers hand and exactly how a buy-sell agreement works to protect everything you've built. If it's useful to you, subscribe so you don't miss what's coming. So most business owners I talk to think succession planning means having a will. They tell me, Greg, I'm covered. My wife gets everything. But a will and a succession plan are not the same animal. And confusing them is one of the most expensive mistakes a business owner can make. A will transfers your personal assets when you die through the probate process. Your house, your bank accounts, your personal property. What a will does not do is tell the world who runs your business tomorrow morning, or who owns your equity, what it's worth, and whether your family gets a full value for what you've built, or pennies on the dollar in a for sale. Business succession planning is the legal, financial, and operational framework that answers all these questions before the question is asked by a probate court, or a creditor, or a business partner who doesn't share your family's interest. It covers ownership transfer, leadership transition, valuation, tax consequences, and the funding mechanism to make all that actually work. You know, when you peel back the layers of that onion, it's a very difficult picture than a simple will. According to a 2026 JPMorgan Chase survey, 70% of small business owners are still in early stage planning or have no formal succession plan at all. Only 8% say they're fully prepared to transition the business. That same survey found that 4 in 10 small business owners plan to retire within the next decade. Think about that for a second. The gap between intention and preparation is where a lifetime of work and saving can disappear in the blink of an eye. Once you understand that succession planning is bigger than a will, the next question is, what are the actual paths? There are 4 core transfer scenarios, and every business owner lands in one of them, whether they plan for it or not. The first is a family transfer, passing the business to a child, a sibling, or another family member. This sounds straightforward, but it's not. It requires a leadership transition plan, a tax structure that doesn't hand Uncle Sam a massive chunk of the value, and enough liquidity to treat family members equitably, especially when not everyone wants to be involved in the business. The second is a key employee buyout, where someone inside the business, a long-tenured manager or partner, purchases the ownership. This is often funded through an installment sale or a combination of seller financing and outside capital. It preserves the culture of the business and rewards loyalty, but requires valuation certainty and legal structure to protect the seller. The third is a third-party sale to an outside buyer, a competitor, private equity, or some form of institutional investor. According to data from the Exit Planning Institute, only about 30% of small businesses that go to market actually sell. The other 70% fail to find a buyer or execute a successful transition. That means if your entire succession plan is, I will sell it someday, the odds are not in your favor. Fourth, and the one nobody wants to talk about, is involuntary transfer at death or disability. This is where no plan, no funded agreement, no legal framework exists, and a triggering event forces the issue. Families scramble, partners disagree, courts get involved, and what was worth $2 million on Monday can be worth a fraction of that by Friday. I want you to notice something. 3 of these 4 scenarios require proactive planning to execute well. The 4th one happens automatically if you do nothing. That's the cascading effect of not making a decision. Now let me give you a concrete picture of what involuntary transfer looks like. Imagine a hypothetical manufacturing company in Central Ohio. Let's call the owner Mark. Mark is 57. He built the business over 30 years, and it's worth approximately $2 million based upon a multiple of the earnings before interest, taxes, depreciation, and amortization. Mark has a business partner, and they never got around to signing a buy-sell agreement. There were always bigger fires to put out. Mark dies unexpectedly. His wife Sandra now owns 50% interest, but has never actually worked in the business. His partner has no legal obligation to buy her out at a fair value and no contractual mechanism to do so. Sandra can't run the business. His partner can't afford to buy her out. Neither of them wants to sell to an outside buyer on a rush timeline. What happens? The business, which cannot operate in this ownership limbo, has to sell its equipment, inventory, and accounts receivable at liquidation prices. Sandra walks away with roughly 40 cents on every dollar her husband built, $800,000 instead of $2 million. That's a $1.2 million loss because two partners never signed a document. Remember that JPMorgan Chase survey we talked about earlier? Mark's situation isn't unusual. It's the norm. Now let's dive into what a buy-sell agreement really does. It is a legally binding contract between business owners that pre-answers three questions before a crisis makes them urgent. Who can buy the business interest? At what price? And how is that purchase actually funded? The trigger events are typically death, permanent disability, retirement, voluntary departure, a divorce proceeding, or bankruptcy. The agreement specifies that when one of these events happens, the departing owner or their estate must sell, and the remaining owners of the company must buy at a prearranged price and upon prearranged terms. No negotiation in the middle of a family emergency, no fighting in probate court. The agreement controls. Valuation is where most agreements fall short. You have three primary approaches. A fixed price written directly into the agreement, which is the simplest but must be updated regularly or becomes dangerously inaccurate as business grows. A formula, typically a multiple of earnings before interest, taxes, depreciation, etc., or revenues, which is a more self-adjusting but needs periodic review. Or an independent appraisal conducted at the time of the triggering event, which is the most accurate but also the most expensive and time-consuming. The valuation mechanism is the centerpiece of a functioning buy-sell agreement. A stale fixed price or a poorly defined formula is almost as dangerous as no agreement at all because it creates the conditions for a legal dispute at the worst possible moment. Funding is equally critical, and this is where I see the most fragmentation. Your attorney drafts the agreement. Your financial advisor sits over there. Your insurance person is focused on something else. Nobody is coordinating. And an unfunded buy-sell agreement is a promise without a wallet. Life insurance is the dominant funding mechanism for death-triggered buyouts, and for good reason. It creates liquidity exactly when you need it. The death benefit is generally income tax-free to the recipient under current IRS rules, and it avoids draining the company of operating cash or forcing emergency borrowing on terrible terms. A funded buy-sell is essential to avoid disruption and potential conflict, and to ensure that the business doesn't suffer financially when an owner exits. For disability and retirement triggers, the funding usually comes from a combination of disability insurance, installment notes paid from future business cash flow, or a sinking fund in the business builds over time. Each tool has tax consequences and timing implications that need to be coordinated across legal, financial, and insurance disciplines, which is exactly why the standard siloed model of advice breaks this process almost every time. Now, before anyone thinks this is only a problem for businesses with multiple partners, let me address that directly. Even sole owners face this problem because a disability or an unexpected death still creates a transfer event. The business has to go somewhere, and without a framework, the family bears the entire weight of that decision in the worst possible circumstances. Beyond the immediate transfer problem, there's a tax layer underneath that most owners never see coming. If you build a business worth $2 million and you die without a plan, that $2 million is part of your taxable estate. Federal state tax exemption in 2026 stands at $15 million per person. But that provision, well, who knows what's going to change in the future. And that value of the business comes in addition to real estate, retirement accounts, and other assets. So the exposure can be real and significant. Then there's the income tax layer on the sale itself. Depending on how the business is structured, whether it's an S Corp, an LLC, or C Corp, the sale of the business interest can trigger capital gains taxes, ordinary income, and depreciation recapture. Uncle Sam comes in and he wants a substantial chunk of what your family receives, and without proactive planning, there's very little that you can do about it after the fact. And then there's the family conflict layer. When one child works in business and another one doesn't. When a spouse inherits an interest in a partner that doesn't want to have them. When there's no agreed valuation and everybody's on different numbers in their head, the business becomes a battleground for unresolved family tensions. A lifetime of work and saving can disappear not in the blink of an eye, but slowly through costly depositions and estate litigation that drags on for years. An integrated legal and financial plan addresses all these layers simultaneously. That's what our 4D estate plan is built to do. To determine the truth of your situation, document a coordinated plan, defend it with the right legal structure, and deliver an outcome that your family can actually rely upon. So to recap, we've learned 3 things today. Business succession is not just a will, it's a coordinated legal, financial, and tax framework. The 4 transfer paths each require planning to execute well, and only one of them, the involuntary one, happens automatically. The buy-sell agreement is the core document that controls the who, the price, and the funding source before a crisis strips you of any leverage. If you're a business owner in Central Ohio and want to find the truth of where your succession plan actually stands right now, reach out for a no-pressure clarity conversation. Call us directly at 614-408-0529.